good morning, good afternoon, or good evening, wherever you are around the globe. We're delighted to kick off the third series of the International Macro History Online Seminar, the third season. And we're delighted to have with us today Charles Goodhart, Professor Emeritus at the LSE and Financial Markets Group at the LSE, also a former member of the Monetary Policy Committee at the Bank of England, and Manoj Pradhan, who's founder of Talking Heads Macroeconomic Research in London. And they're going to talk to us about the great reversal, demographic reversal of the last 50 years and give us some forecasts about forthcoming inflation. So without further ado, Charles, I'll give you the floor. I want to remind people in the audience of our procedures here. So if you have any questions in the first 40 minutes, then please put them in the Q&A button at the bottom of your screen. Do not use the chat button, but use the Q&A button. We'll collect all the questions, and after 40 minutes of uninterrupted presentation by Charles and Manoj, we'll open up the floor for 20 minutes of Q&A session. This will be followed by an optional, from your part, not ours, 15 minutes additional time for more informal questions with the presenters. So just again to recap, 40 minutes straight. If there's something that is completely you don't understand, put it in your Q&A and I'll stop the speakers, but otherwise they're going to go for 40 minutes. And please use the Q&A button and not the chat button when you're inputting your questions. So Charles, the floor is yours.
Thank you very much, Nathan. It's a great pleasure to be with you all. I'd like to start by reminding everybody that the last 70 years have really been quite extraordinary in comparison with the several centuries that went before them. This chart shows the time path of yields on Consul, very long-term government bonds. And as you can see, from the time that the Bank of England began at the beginning of the 18th century, in 1694 to be exact, Consul yields remained really pretty steady at about 3.75% to 4%, all the way up to about 1950. Then from 1950 until about 1980, Consul yields rocketed up until at one point, at the highest point in this diagram, the yield on Consols was about equivalent to its price at about 16%. And then it collapsed again. Now, the main feature that caused increases in longer term interest rates in deficits and debts during the earliest centuries until 1950 was actually wartime. And it was war that led to greater government expenditures, led to government deficits, and led to government debt. But wars were temporary, and as long as you were on the winning side, as the UK normally was during these years, with a few exceptions, effectively you realized that after the war was over, government expenditures would come right back, public sector finances would remain relatively small and prudent and stable, and therefore you expected short-term rates, which went up during wartime, to come back to normal over the future period, and with monetary conditions stabilized by maintenance of the gold standard, you didn't expect inflation. Now, all that changed about 1950. It changed, in my view, largely because of good intentions, because those in power from 1950 onwards usually had their childhood during the Great Depression in the 1930s. And for them, unemployment was the great evil. Nobody quite knew what the equilibrium rate of unemployment was. And on the whole, the authorities tried to keep unemployment as low as they feasibly could, even at the expense of some inflation. And when inflation occurred, they tried initially to deal with it by direct controls, prices and incomes policies, which didn't work. By that time, inflationary expectations began to become embedded in the population. And with the continuing attempt to hold underlying inflation down and a vertical Phillips curve, you got effectively a continuing rise in inflation. That finally got turned around with great courage and some difficulty, and indeed a period of very considerable danger, a greater financial danger of anything before the great financial crisis in the very early 90s, from 1979 to 1982, by Paul Volcker with the support of Ronald Reagan and Mrs. Thatcher. So undoubtedly, a great deal of this pattern has been due to changing monetary regimes, with the gold standard breaking down with the end of Bretton Woods, and then with the restoration of a better monetary policy with central bank independence and inflation targets. However, a key element in our story is that we do not believe that the disinflationary trends that you saw from the beginning of the 1980s to 2020 to the present has been entirely due to better monetary policies, or undoubtedly it was quite largely due to better monetary policies. The reason we say that is that during these years, these 40 years from 1980 to 2020, interest rates were trending, both nominal and real, steadily downwards, which doesn't indicate that central banks were having a massive problem in maintaining their inflation target. And indeed, from the date of the great financial crisis onwards, from 2008 through to 2010, the authorities since then have actually not been able to restore inflation to its target of 2%, despite throwing everything that they could: negative interest rates, quantitative easing, forward guidance, you name it, they've tried it at the problem. So something else was going on. And what we argue was going on was an increase in globalization and a very beneficial demographic framework. Let me take first globalization. On the chart on the left-hand side, the blue line, the solid blue line, was the number of those of working age population available in the advanced economies of the West, Europe, North America, Australasia, etc. The yellow line shows those economies who entered the world's trading system from about 1990 onwards, particularly China, which has the world's largest population, but also, and importantly, Eastern Europe after the collapse of the Soviet Union. And you can see that because of the size of China, and indeed of Asia, Northern Asia more generally, plus Eastern Europe, which is the yellow line, this enabled those employers who could move their production from the high wage advanced economies to the much lower wage countries of China, other parts of Asia, and Eastern Europe, that the available labor supply that they faced now effectively more than doubled. In other words, it shifted from the blue line to the blue plus the yellow line. Now, this was the greatest positive supply shock to the labor force that the world has ever seen, effectively within about 30 years, more than doubling. The only equivalent historical example that I can think of goes in the opposite direction, which was the Black Death, where the bubonic plague killed such a large proportion of the workers that the labor supply declined very sharply and wages went up very sharply in response. You could describe this as the revival of China, because China had been the leading economy in the world for millennia. Its workforce was reasonably well educated. It had competent administration. and it had a long economic history. And they, together with the Eastern Europeans, were able to slot in to the world's trading system very effectively, with exports from China rising from virtually zero at the start at about 1990 to about 25 to 30% of total world exports. On the right-hand side, you can see how the working age population jumped steadily through this period. Now, there are several reasons why the availability of a competent workforce, well-organized workforce in Eastern Europe and China with very low wages led to disinflation. First, of course, shifting production to low-wage economies enabled the products, goods, and services there to be produced much cheaper than in advanced economies. Second, the ability to shift work to the low-wage economies, which had entered the world's trading system, gave the employers a credible threat to stop any serious wage increases in the advanced economies, with the result that as both a symptom and a cause of what was happening, the power of private sector trades unions collapsed during these years. Where now are the National Union of Mine Workers or the Union of Auto Workers in the United States? Effectively, the power of trades unions has been totally reduced, sharply dissipated. And finally, this trend of manufacturing to these low-wage economies meant that in the high-wage economies, the share of services within our economy increased very sharply, and the share of manufacturing went down very sharply. And labor is much better organized for reasons that you will all know quite well in manufacturing than in services. Now, all this coincided at a time with a very beneficial trend in demography in our countries at the same time. What was happening in our countries was that from the time that the baby boom ceased, the birth rate started to go down very sharply from the sustainable rate of 2.1 children per woman to somewhere in the region of 1.7, 1.9 in many of our countries, with the result that the proportion of the young in our economies went down very sharply. And this occurred before life expectancy increased sufficiently to bring about a very sharp increase in the old. So what you can see is that between 1970 and 2010, the decline in the proportion of young in all our economies, with the exception of Japan, increased far more than the increase in retirees. In the last decade, from 2010 onwards, that has again reversed, with the proportion of young remaining again relatively low, but now stable, and the proportion of old beginning to increase quite sharply. Now, that has a number of disinflationary effects as well. Putting it all very simply, you don't pay a worker as much as the value of the production that worker produces, otherwise it wouldn't be economic. Moreover, the worker has to save for their retirement. So an increase in the proportion of workers is disinflationary, while the young and the old consume, but they don't produce. So they are virtually by definition inflationary. And there was a further factor as well during these years, which was that the decline in the birth rate, together with the increased availability of consumer durables, washing machines, fridges, deep freezes, microwaves, etc., enabled a much higher proportion of women in the working age population to actually participate in the labor force. So for all those reasons, the demographic shifts over the last 30, 40, over the years from 1970 to 2010 were exceedingly disinflationary. In particular, one of the features is that the old are going to be much more expensive because they become medically dependent. Medicine has done wonderful things over the last 40, 50 years, improvement in cardiovascular treatment, great improvements in cancer treatments, hip replacements, cataracts, you name it. The one area where they have actually tended to fail has been with neurodegenerative diseases, Parkinson's, dementia, where there's really been no improvement, no breakthroughs whatsoever. And one of the problems here is that as you get older, the number of those who become medically dependent, quite largely because of neurodegenerative diseases, increases as a function of age. When you are very, very unlucky if you get one of these neurodegenerative diseases, if you get Parkinson's or dementia before you get to 60. What are known as the young old, between 65 and 75, it becomes about 1 in 3, not quite 1 in 3 who become medically dependent. With the old, between 75 and 85, it's about 1 in 2. As you get much older, over 85 and into your 90s, by the time you're 95, you just about have to have medical carers to look after you. You just cannot cope. And that means that the old are much more expensive than the young. And in the advanced economies, it is not true that we equate consumption over our lifetime. The very young actually don't consume very much. And when you get older in the advanced economies, your need for care and medicine, particularly care, goes up really quite a lot. So that the aging society, unfortunately, is going to be the society that needs a great deal of care to look after those who are, if you like, quote unquote, benefiting from much greater life expectancy. As I'm getting to the old generation myself, I can tell you that we do like to live longer, but it does mean that a massively increased proportion of us are going to require considerable care through our old age. Now, one of the effects of all of this is going to be a change in the nature of inequality throughout the world. And I'm going to turn over to Manoj to take you through that.
Thank you very much, Charles, and thanks to our host for giving us this opportunity. I often remark that Charles is really the wrong person to be talking about old age and medical dependency, because his work rate is furious. It's almost impossible to keep up with, but the statistics do bear him out. It is a very difficult problem, as both of us will tell you from very personal experience in our families. It's a difficult proposition. But turning on to the point that he had made, one of the things that has changed along with the economic consequences is the social consequences. And for a long time, while we had the really good periods of growth with extremely low inflation, while everyone's personal incomes were rising, that social inequality did not really create a concern. But when the great financial crisis struck, and then we were stuck with both social dissipation of equality, and we also had an economic burden on our shoulders, that's when the problem became too much. But if you look at the statistics, this is what Charles and I agree is probably the single most striking statistic in our book. On the left-hand side, you have the ratio of workers in America, with the wages of the workers in America to China. And just about 20 years ago, that ratio was about 35 times. In 20 short years, that ratio has now come down to 5, which is a factor of 7. As Charles mentioned earlier briefly, China really had been in the dominant superpower, if you will, for most of history. It's only in about 200 years or so that it had lost its supremacy. And over the last 30 or 35 years, and especially since particularly the opening up of the economy in 1979, China really started to gain some ground. But what we're trying to show over here is that global inequality actually declined quite a lot, because China was able to use not only its system of very efficient workers, but what those workers had built into their working was a system of guilds, was a system of transfer of knowledge, system of transfer of technology, dissemination of technology that flowed through. And don't forget, China was a portal for emerging markets. So the emergence of China fast-tracked the growth of intermediate goods producers among the commodity importers, and rapid commodity production among the commodity exporters, both of that led to a strong support for current accounts. So effectively, even though inequality is a social problem, we do have to keep in mind that global inequality over the last 30 or 35 years has actually gone down. And that's a point that Milanovic has made quite impressively. However, and this is the problem that socially we all have to contend with, within country inequality has suffered. Now, this is a chart from Auteur, and what he shows in here is this wide dispersion between labor of different skills. What Charles and I are arguing is that the same a huge supply shock to global labor that led to massive disinflation, led to falling interest rates and rising asset prices, also had negative social consequences, because it was aimed at the relatively lower skilled workers who find technology to be a substitute. That technology, when deployed and shipped off to China and emerging markets, was able to move employment out of the advanced economies and move investment over to China. In fact, the Federal Reserve note called the surprisingly swift decline in US manufacturing employment is an excellent study at the micro level of exactly how these jobs shifted. And even if you look at global inequality narrowing, what one can point to even within China is that national inequality in China was probably more of a questionable variant, because the way investment was fast-tracked was through financial repression of households whose savings were moved over to banks, and then banks moved them over to state-owned enterprises who moved very efficiently into production. But all of that has meant that social tensions have been rising, and along with that rise has come the rise in populism. And so what really worked for populist governments was that they were able to attract a large part of the working class population because of their stronger stance towards immigration, which the more affected laborers in those economies were satisfied was an important cause. It may have been in part, it may not have been, but it was at least very successful as a political strategy by the far right, and that has led to the increase in populism. One of the things, regardless of which bent the administration has had, is simply that they have been forced or led into higher debt. And this is a problem that I think governments will find very difficult to deal with. But for that, I'll turn it back over to Charles to walk you through the debate.
Thank you very much, Manoj. One of the great differences between now and, shall we say, World War II or World War I, is that World War II and World War I were temporary. What we have in prospect, even before the COVID struck, if we can go back one slide, please, is that on the basis of present policies, including policies with respect to pensions, policies with respect to medical support, and so on, and present tax policies, the outlook for deficits, including primary deficits, were that these were going to go on as far as the eye could see. This slide is done by the Office for Budget Responsibility in the UK, and this is the projection that was made in 2019 before anyone knew about COVID, and shows the deficits in purple below the zero line, i.e. that the deficit's going to increase, and the yellow line shows the debt rising exponentially. And the same is essentially is true of the USA. The outlook for deficits, primarily because of the aging population, was there even before COVID struck. What we've had, of course, is that the need to deal with COVID and the expansionary financial and fiscal policies, which I fully supported, at any rate during the first year, led to a very sharp rise in debt and a massive rise in deficit. But this expected increase in debt and deficits was there before COVID. It had nothing particularly to do with COVID, which just gave a strong upward burst to that. So the implication is that unless policy changes, there has got the outlook for debt and indeed deficits and indeed monetary growth is unsustainable. So where have we got to? What is the sort of the end game that we see now coming up? Our expectation is that inflation will occur, and I'll try and walk you through that. First of all, the best and nicest way of dealing with a high debt ratio is to grow out of it, to have growth growing faster than the level of interest rates. The problem that we now face is that growth is likely to slow down because the working age population is going to grow much slower. And in the strongest growing countries like Germany and like China, the working age population is actually going to decline from now on. And indeed, over much of continental Europe is going to decline. And growth is a combination or a function of the growth in the working age population and the increase in productivity that those workers can bring to bear. Now, we do expect productivity to increase as offshoring falls away with the retreat from globalization, and we get more onshoring. And again, the COVID pandemic has reminded all of us about the need to have some of the strategically crucial industries in your own region or country. And with greater onshoring, less offshoring, we expect more investment at home and more productivity increase. But we don't think that we do think that overall growth is more likely to fall away to perhaps to Japanese levels than to increase. Under those circumstances, we have got to reduce the primary sector deficit. But taxation, although probably the right solution, is politically very unpopular. I know of no taxes which are politically popular, even such taxes as everyone thinks are appropriate, like a carbon tax. You've only got to remember the Gilets jaunes and the problems that Macron faced to realize that the likelihood of sufficient taxation to restore a primary surpluses in the foreseeable future is pretty unlikely. Now, if deficits are going to continue with the expansionary implication that that has, can we deal with inflation through increases in interest rates? Well, the problem here is that the debt ratios are so very high that increases in interest rates cause very great problems for public sector finances. The debt service ratio has actually been stable or decreasing despite the very large increases in debt in all our countries, because interest rates have been declining in contrast. But in the future, that's not going to happen. And also, the private sector is now burdened by high debt. The corporate sector, not the personal sector so much any longer, but the corporate sector is now so burdened by debt that any increases in interest rates could put financial markets and the solvency of many of our corporates really into question. So we think that the idea that the central banks can and would, if interest rates rose, raise, if inflation, it can and would, if inflation rose, raise interest rates to a level sufficient to bring inflation back to target. I think it's going to be much more difficult and worrisome than central banks would now like us to think. With the result that we think that inflation, though unattractive, may be the most easy political outcome necessary to deal with the excessive debt that we have already accumulated and look like accumulating even further into the future. Now, one of the problems with our thesis was that we did not really know when these underlying trends of globalization and demography, which had already turned round from 2010 onwards, would have sufficient momentum to restore labor bargaining power, which had been trashed in the previous 3 or 4 decades. But we're inclined to think that the COVID pandemic will actually prove the trigger for the shift from a disinflationary to a more inflationary world. First of all, we think that in the short run, there will be a blip to inflation. The monetary aggregates have been increasing at remarkable rates in many of our countries, notably in countries like the USA and Japan. In many sectors of the economy, which have accumulated debts and have been closed or in difficulties, many of the companies will have to increase their markups. And increasingly, we do think that the political and other pressures that are increasing on the labor front will lead to a restoration of underlying inflation. It won't happen in the short run, because in the short run, central banks and most everyone else will welcome a small degree of inflation as long as it doesn't go significantly above 4%. The problem is going to be whether in 2022 or 2023 it will return to target. One of the things we did not discuss in our book was climate change and the environmental focus. And again, we think that for a number of reasons, the fact that there will need to be a great deal more investment in, for example, flood protection, wind turbines, and green technology, before the benefits of that arise, will also in the short to medium run be quite inflationary. So for all these reasons, we think that the world is likely to become more inflationary, and perhaps even in the next few years. But our concerns about this are not shared by the great majority, the mainstream of economists, though the conversation and discussion is beginning to turn, particularly with the very massive Biden expansionary plan that is being put forward now in the US. But for the reasons why our message has not been generally accepted, I turn again to Manoj.
Thank you, Charles. In the interest of time, I'll go over some of these in a little bit more of a rapid fashion. We can come back to these in the Q&A if there's interest. Broadly speaking, the pushback that we get against this thesis is put into 5 categories. I'll go over some of these. I'll pay a little bit more attention to Japan and then conclude. The first one, numerically, if you remember Charles's earliest charts, you see that certain parts of the world, in Africa and India, some parts of South America, the numerical advantage that they have in terms of demography is actually enough to offset all of the numbers in aging that you see to quite a large extent. The problems with this thesis of looking at the numerical side of the story are threefold. Number one, the bulk of the contribution to growth is coming from economies whose workforce is going to decline. And that is going to mean that Others will have to grow significantly faster for a very long period of time if their labor force is to account to anything. Number two, it's very difficult to think that in this age of populism with immigration policies where they are, we can take a large part of that labor force from Africa and India and bring them over to the shores of the advanced economies to help with lower skilled work, even medium skilled work. Immigration policies are beginning to get more and more targeted, but those are unlikely to be really large as far as numbers are concerned, and far more where the economy needs it. So why not then, if you can't move labor, why not take capital, financial capital from the advanced economies, managerial capital, over to these countries like was done in China, and then turn that into output and bring it back to the advanced economies? It's a good thought, and some of that is already happening. India's FDI inflows, if you look in the last few months, have been simply outstanding. However, the problems are in turning that capital into output. The administrative capital in these economies is very low to begin with, is very hard to raise. Against that, China had the backing of the central government, and state-owned enterprises were incredibly aggressive because they had access to private savings and the US consumer. If you go back to the point that both Charles and I made earlier, what China also had the benefit of was centuries and centuries of organization of labor into very organized units that were efficient, that were able to disseminate technology. India and Africa simply have not had that at grassroots levels, where their village level industries have been far more rudimentary. And finally, if you look at Africa, for example, the population size is eerily similar to that of India. But there are 50 countries involved in there. And that means the coordination of 50 different national policies to come up with a unified strategy that can produce enough goods and services to offset global demography. We think those parts are going to grow well, India and Africa, but they simply will not become another China, let alone multiples of China. So why not then limit the benefits of the old, get the participation of the elderly to increase, and why not use technology to offset some of this? Well, some of this has already happened. The participation of the elderly has gone up significantly, particularly because of the increased participation of women that Charles spoke about, but also because of the reduction of benefits to retirees. What you see over here is a broad increase in this very important cohort of 55 to 64-year-olds, that's a typo in there you can ignore, who raised their participation from somewhere in the 40s in some cases to nearly 70%. In particular, the most interesting case over here is probably that of Germany, which is the green line. And what you see is that the pre-retirement German worker was coasting along at a participation of around somewhere in the low 40s. And then in 2003, the Europe Commission tabled very credible and strong reforms that were then built upon, which reduced the burden of the national government in providing retirement benefits. And from that point onward, participation of the workers increased substantially to exceed 70% now. As this cohort retires and becomes post-retirement age in the next decade, how much more blood can we squeeze out of that stone? Participation rates are already so high that getting a huge boost is very hard. So then we come down to technology. And in this, the main conclusion that Charles and I have taken, we're not technology experts, is that robots can help look after the elderly. There's a very nice NBER paper recently on nursing homes in Japan, and they show that they're complements to nursing, but they are not substitutes, and we don't think they will be, because the main thing that people, particularly those with neurodegenerative diseases, need is empathy, and robots cannot provide that. If you don't have that, then Charles and I actually depend on technology crushing repetitive tasks in the rest of the economy to release labor. So that labor, in the absence of strong immigration, can then be somehow redirected, or at least an equivalent redirected, to a crisis of caring that we think will otherwise materialize. And so finally, all that remains as far as criticisms is concerned is Japan. And rather than go through everything over here, two of these are very well known. I'll make just 2 points. So Japan is often seen as a blueprint for aging. However, we think it is misunderstood. We have a very different take on Japan, and one that takes a global footprint into serious account. And the question we ask is, how could Japan do anything but disinflate and see falling interest rates when its demography turned at the same time that China was in the ascendancy. So China disinflated the entire world. Japan had no way to stop that force at its borders, and hence inherited that disinflationary pressure, moved people from manufacturing to services, used its labor force mechanisms to move people into part-time work, adjusted hours instead of employment, and actually, on the whole, the corporate sector in Japan did rather well. The top chart is very well known, which is that Japan's output per worker has increased by around 2%, something that most advanced economies would bite your hand off if you offered it to them right now. But a less known part of the story, which we've spent quite a lot of time pulling out of Meiki reports, and we believe is a new contribution to the Japan debate, is that Japan's corporate sector was actually aggressively profit maximizing by going after labor where it was cheap. It invested, produced, and employed people outside Japan at an incredibly aggressive rate. So all the overseas to domestic ratios went up in a straight line after that lost decade, something that within Japan is known as the divine wind. So rather than being a blueprint for what the world is going to look like, Japan's disinflation was actually a product of China and the overall dependency ratio stories that Charles has outlined. Going forward, Japan is going to be like the rest of the countries. But in conclusion, we think, number one, inflation is coming. One of the questions has been, you may want inflation, but are you able to generate it? What we have argued here is that the structural forces that kept inflation low are reversing, which takes away a very strong support for this inflation. And second, while you had a post-financial crisis recovery led by central banks pushing money into the financial sector who wanted to protect their balance sheets, this time the fiscal stimulus has gone into the real economy, which is far more likely to spend without any need for funding for lending programs, where demand will continue to outstrip supply, especially with this new budget that has come out in the US, and the likelihood possibly of another one, as the New York Times and Politico are reporting. Second, we think the yield curve will steepen. We don't think central banks, particularly in the US, after inviting fiscal policy over 2020 and particularly towards the end of 2020, can or will act, especially when they've taken on average inflation target. And if anything, should they try to keep nominal yields lower, even around 2022, that will lead to a pro-cyclical push upward for inflation. And you can see that some of this is already being priced in by markets, because break-even inflation, which is the difference between nominal and TIPS yields, is everywhere above the nominal interest rate curve. The combination will mean that after this initial big bounce in the equity prices that you've seen, structurally speaking, asset returns will be harder to extract. We think housing markets may do rather better than people are expecting, but overall asset returns will be harder. The benefit of that will be that within country inequality falls. But one of the topics that Charles has written a lot about and is going to be particularly interesting is that for the last 30 or 35 years, central banks have done exactly what any administration would have wanted. But if inflation is indeed going to rise and central banks find it very difficult to allow that to happen without a fight, they will come into increasing conflict with governments, and that will threaten central bank independence. But I'll leave it there. And Nathan, turn it back to you now. Thank you very much.
Well, thank you very much, Charles and Manoj, for this very interesting and thought-provoking presentation. It leaves us with a lot of questions looking forward. And so I think I'll unmute Mike Bodo, who wanted to discuss further some of these issues.
Hey, Charles, you know, I really like your book, and I've listened to a couple of these webinars with you. So I want to get, in a sense, it'll come. My comment comes from the very last thing that was said, to look at the current debate in the U.S. over the size and consequences of incoming President Biden's COVID stimulus package of $1.9 trillion. And there's a big debate about that that's going on right now between those who think, like you, that actually it is going to be there is going to be inflation, and those who don't. And the Biden people and the Fed doesn't think that it's a problem. So the real issue is about the size of the fiscal deficits and the accommodative policy of the Fed, and whether this will trigger a rise in inflationary expectations and a rise in inflation above what the Fed's willing to tolerate. We don't know what that is, but maybe 2.5%. And so the question is relating to you is like, that debate, I think, focuses on the short term and the medium term. So when does your stuff come in? Okay, because it seems like your stuff they're paying lip service to your stuff, but it's not being taken seriously. So I wondered if you could comment on that.
I think that the timing of the change in globalization and in demography is inherently uncertain, largely because the bargaining power of labor has been so dramatically reduced over these last 3 decades. When will the bargaining power really come back? I think that my inclination is to say that the inflationary blip that we are expecting over the next year or so is going to make people more concerned about future inflation, and the strength of our economies is likely, together with the changing underlying trends and the political forces, for example, raising minimum wages in many of our countries, to bring about stronger, persistent inflation than most of those in authority and in central banks now appreciate. And of course, we could be wrong, but we think that there is a likelihood that the COVID pandemic will bring about an acceleration of the changes that in the medium to longer term, we are fairly confident would have anyhow led to stronger inflation. But Manoj, is there anything you'd like to add to that?
Just a couple of small things. One is, as Charles said, the book was mostly written in 2019, and yet when the pandemic descended upon us, Charles and I had a note somewhere in the first half of last year already talking that inflation would rise as a result of the policies that were then in place. So on the 4th of January, before the Georgia result came out, we thought it was an issue. On the 6th, once we had the concept of a blue sweep and this fiscal package that was almost sure to come, it will only have reinforced our conviction. So maybe we have confirmation bias on our side, but it has been an inflationary story for us all along. Nothing that we've seen out of the new administration is anywhere close to reversing that. It's only reinforcing that trend, I think.
One thing I would add is that we are not in any sense criticizing the fiscal expansion and indeed the monetary expansion that occurred during the pandemic. But the problem is that many of the fiscal measures will probably not take effect now until after the vaccines have actually led to a normalization and an ending of lockdown. When that occurs, there is quite likely to be quite a sharp jump in expenditure and in activity. And so what has been correct in the past may turn out to be extremely pro-cyclical from about midsummer onwards.
Okay, so I have a few more questions. So I think from 3 different people, again, on this topic of the U.S. fiscal expansion, and then we have some other questions we can or things to talk about. So the first is whether is the particularities of cash in hand versus cash in kind could change some of the outcomes of the fiscal policy pursued right now, in the sense of being less inflationary. That's one question from Dr. Maria Freen. There's another question from Hassan Safdar about the Blanchard and Summers idea of R minus G, that with respect to increasing fiscal spending in the advanced economies and dealing with the secular stagnation we've seen so far. That's another related question to this policy. So can you elaborate a little bit on these things?
Well, on G minus R, we think because of the decline in the working population, or the decline in the rate of growth of the working population, that G is actually bound to go down a bit. Because of the problems of debt, we think that it is very important to keep R down too. And one of the ways in which R is going to be kept down is that inflation will be allowed to rise above the nominal interest rate, which will be held down. On the first question about use of money, I listened in to a very interesting debate between Larry Summers and Paul Krugman. And Paul Krugman was arguing that the increased savings and the increased money holdings in amongst our persons and corporates would not be spent when normality occurred, because there would still be very considerable uncertainty about the future. And this is actually a fairly key point. And the velocity of money is virtually at an all-time low. And the monetary growth is going to be very rapid over the next 6 months as well, at least. And personal savings ratios, again, at an extraordinarily high level in most of our advanced economies. And the question really is, how far will these reverse? Nobody thinks they're going to reverse all the way back to what you might describe as the trend normality of recent decades. But even if they reverse a bit, we are almost certain to get a growth of nominal incomes well in advance of the growth of real output. In other words, this is another way of describing the inflationary pressures in the short run.
If you look at ECB research also, I think it was, if I'm not mistaken, is the June monthly bulletin in which there was an estimate or there was an exercise to estimate what is the quality of these savings. And I think their bank, the Central Bank of Brazil, has had a very similar study. And both of them suggest that the savings are not precautionary, predominantly, they're forced savings. And that seems to go very well with the shutdown of the services sector. And that seems to go hand in hand with the decline in velocity as well. We're not spending a large part of our consumption basket. Cavallo at Harvard has also shown that the CPI basket and the COVID basket have very different weights. All of that seems to gel together. So if 2020 was a year of moving from macroeconomics to COVID economics, in 2021, most of it seems to be moving back. I think we should expect some kind of normalization of all these trends. They may not go, as Charles said, all the way back, because who knows how far working from home and the like will go. But at the very least, we should be expecting some. And really, 25% M2 growth in the US is well in advance of anything that's happened in the last 30 years. It's something I don't think we should be disregarding all that easily.
Okay, so we have a few more minutes remaining in the formal part. So I have a few questions on what I can characterize as the mitigating factors. So one is related to technology. Why are you so pessimistic about the kind of capping of the technological revolution now that we're seeing this new technological revolution? Why would that continue or even accelerate and provide the more supply side backwind or headwind to inflation, to avert inflation? That's one. The other thing is, the other issue is related to the Japanese case and birth rates, and from Matsuo Shizumi, who is asking something about the low birth rates. There are concern, obviously, in terms of your demographics, but could that change? So, is it deterministic that the birth rate will continue to be low? Could we spend more on children as opposed to other goods? So there could be a shift there as well that could mitigate some of these things looking forward. And finally, again, looking at the case of Japan, let me ask a question about is it not possible to, in some sense, at least for the medium run, to repeat the Japanese experience as taking the entire or large components of the advanced economies and investing in, say, Africa, those places, and basically investing abroad, something the British did in the late 19th century when they invested in all these emerging markets economies and enjoyed the revenues from these investments for decades. And at the same time also promoting development elsewhere. So could this not repeat itself in terms of siphoning some of these savings to Africa and other places where growth, where the G is still potentially very high, and then we can live off the income from those investments as the British or Japanese did. So these are a lot of questions. So we have 3 or 4 more minutes. So, well, we can continue later on in the informal part.
Manoj, do you want to start?
Yeah, certainly. So I'll take a crack at the India and part of the Japan question. So the India question and the Africa question is not wrong. It is absolutely right. That is exactly what is going to happen. And we all know that the potential for pushing G even higher is primarily because these countries are inefficient. If they're already at the efficiency frontier, what more productivity gains could you have from them? So they are seeing increased inflows. They are doing a lot of things. And in fact, if you look at India, as I have been naturally following, but also for work, out of the last 15 elections, I could tell you with a fair degree of confidence that more than 12, if not 14, have been won or lost on economics. That wasn't the case. When I was growing up or much younger, if you're a movie star and got into an election, you were very likely to win. If there was a religious problem, you're very likely to win. That's not the case anymore. There are hundreds of millions of young people who are fighting for governments to give them jobs, and that is a very serious matter that causes a sweat on the brows of any administration, whether it's Africa or India. So you're absolutely right, it's going to happen. The question is whether that is going to be enough to offset the aging problem in the advanced economies. That's where we think the story can fall short, because you had, in some senses, you had a massive amount of change that could be very easily absorbed by the Chinese economy, where they had the Pearl River Delta. There was one and only one Article 4 research piece in which I saw the IMF had tried to estimate the amount of subsidy that was given by the Chinese government to land, labor, and capital in the Pearl River Delta. And it was massive, and it was gigantic, and it was rising. That's not something that is available to individual states in Africa. There is not enough coordination between the center and states in India. So states try to compete at a state level for this kind of FDI. We think it's coming, but the ability to transform capital in big enough numbers is just not that aggressive, because the central government doesn't play a large enough role in Africa. There are too many central governments, if you will. So the transformation part is not there. I think the countries will do extremely well. There's a rosy future for a third of Africa, which already has better ease of doing business standards than China, and another third, which has better ease of doing business standards than India. But it's not enough, we think, to offset a lot of the aging problems that the other economies have. So if you look at Japan the same way, Japan had an option of offshoring to Poland, to Brazil, to Taiwan, Thailand, and China. Right now, that option is much smaller in terms of human capital. And finally, when it comes to Japan, it's not really, the question I think is, if I'm not mistaken, is asking whether fertility broadly is endogenous or not. And yes, there clearly are endogenous responses where governments, particularly in Russia, had made it very profitable for you to have more children, and they try to encourage childbirth for very different and more populist reasons. We've seen some of those policies in Central and Eastern Europe also. But that generally tends to not work as aggressively as the other way around. So what we've seen is that the decline in fertility has been far more responsive to economic conditions than any pickup in fertility has been to any policy that tries to encourage childbirth. It may change. and it may go the other way. And finally, as far as technology is concerned, I don't think we're pessimistic. The one part where we are pessimistic is we don't think that robots can look after the elderly. And if you accept that, then I think under immigration laws, it becomes clear that we actually encourage technology to destroy job elsewhere, so we can create a flow of relatively low skilled workers to look after the elderly. We can't see that right now because our societies are not yet overwhelmed with people who need attention. But as that rises, I think the attention will be evenly split between where technology is destroying jobs and where the services sector is protecting jobs by pushing them more into the caring side.
Okay, so thank you for these answers. So we exhausted our formal 60 minutes, and I'd like to thank Charles and Manoj for their presentation, exciting presentation, a lot of food for thought. Looking forward, and a great kickoff for our third installment of our series. So now we'll switch over to the informal part, and we ended the formal one, and we can have a more relaxed chat in the next 15 minutes or so, depending on the demand for questions. So, Rui, can you unmute yourself and join us? You wanted to also ask some questions.
Fantastic, thank you. Thank you, Nathan. So this might be a bit unfair since you wrote your book in 2019, pre-COVID, but I want to push you a little bit more on COVID economics. So a pretty famous paper by Jorda, Singh, and Taylor tried to estimate the long-term consequences of past epidemics. And they have this very striking prediction, or at least estimate, that we should expect something like a drop of 1.5% in the natural rate of interest, perhaps over the next 20 years. And this essentially has to do with a mechanism that comes from straightforward growth theory, because destruction of labor without capital, of course, changes the relative return to the two factors of production, and hence might have this long-term dampening effect on an already very low natural rate. So would you have a comment? How would this fit on your overall?
And that's not at all inconsistent with our position. But what our position is that the decline in the natural real rate of interest will occur because inflation will be allowed to rise above the nominal rate of interest. And it is that force of inflation going up relative to nominal interest rates that will bring about the decline in the natural real rate of interest that Alan Taylor and others have suggested is a normal response to these kind of crises.
Did that answer your question? You dropped out.
Sorry, yes. Although you are aware their mechanism is different, right? It's a real mechanism. It's not driven by the expectation of inflation that you're building into your.
Well, initially, people's expectations of inflation at the beginning of COVID, the expectations of inflation went way down. They're now beginning to rise again, particularly as a result of the policy measures in the US. Indeed, expectations of inflation may rise to a point where it begins to influence wage and price setting.
Let me pick up on some of the monetary fiscal debt related background to your presentation. So let's leave it aside for a moment, the real factors. So proponents of these spending, the US spending programs, also in Europe, basically are claiming that since nominal interest rates are basically zero in terms of government debt, and what matters for fiscal balances is servicing the debt rather than paying it down. You remind the English consuls that were held for centuries, and so there's no need to repay the debt, but as long as the service charges on the debt are very, very low, have a very low fiscal impact, this would allow, after the big spending programs, to actually go back to some more traditional fiscal uh, um, behavior where sort of you would see fewer deficits or even surpluses, and the key variable here again is the interest rate, the nominal interest rate.
What I find fascinating is that central banks, and most of those in authority, are actually following modern monetary theory, or as I like to talk about it, the magic monetary tree, which says you really don't have to worry about deficits until they start to introduce inflation. While at the same time, central bankers and others are saying that MMT, or modern monetary theory, is all wrong. I've never seen a situation where a theory is so criticized in theory and actually followed in practice. It's weird.
Let me ask the audience, are there any additional questions that you want to raise, ask?
If I may, one quick thing, Nathan,
Sure.
before we move back. The point that you're making, which is that if you keep debt servicing costs low, there may be two parts to it. One is that we may be wrong, and we may see interest rates remaining low for a very long period of time. Inflation may turn out to be temporary, nothing happens. The second path may be that along the lines that Charles has mentioned, which is that central banks force interest rates to remain low. So if the nominal interest rate remains low, you really can't fight them. You lose your shirt if you do. But don't forget that changes matters quite a bit. So for example, for central banks that have avoided raising interest rates, again, if you look at the example of Poland or Hungary, whenever growth rate, inflation, or productivity had adverse trends, you saw the yield curve steepening a lot. Now you could come in and say that, well, you can't threaten to have Operation Twist or something along those lines. But under those circumstances, markets are flexible, or if you will, complete enough to push break-evens higher. And break-evens themselves provide a pretty big signal. If you look at the dollar story has moved well in line with rising yields. If break-evens rise and push real yields down with the threat of yield curve targeting, then the dollar tends to slip down. If real yields rise where inflation is not a problem, the dollar tends to rise. I mean, these are simple correlations which we should not read too much into. But the bottom line being, if you force one part of the financial market structure down, it's not clear that the problem is solved, because then those inflation projections start getting priced into equity markets, into credit spreads. And if corporate sector does not have the same ability to extract inflation revenues from the government, then you may see crowding out or investment damages of a very different kind. So I don't think we should think that central banks can repair the problem no matter what happens. As I think Vice Chair Clarida had said, we know how to deal with inflation. They may know how to deal with inflation, but actually implementing those strategies, I think, probably is a whole lot harder than most central bankers believe.
Thank you. Any other open questions? So we have one additional question. Let me see if I can unmute Hassan.
Okay, so I have a question regarding for the Eurozone. I mean, what policy suggestions do you have for Eurozone countries which have very bad demographics, as suggested by Charles, and low growth rates, large output gaps? I mean, very high unemployment rates, for example.
That's a very difficult question.
I'm sorry, but it just was bothering me all the time.
It's not an easy question. The ECB is, I think, in a very different place from the Fed. And the ECB is protected from government intervention by treaty. And I think that the ECB will ensure that inflation doesn't rise. And if America becomes more inflationary, as it may well do, and the dollar goes down, then the euro will go up, and it may well be that there will be a move into euros out of dollars, and that will have further depressing effects on the euro area. So that the outlook, I think, for the euro area is unfortunately continuing really much slower growth than elsewhere, and also lower inflation than elsewhere. How you get growth up while holding inflation to target is a very difficult question. And the standard answer is, of course, supply side reforms. But it's easier to say that than to actually indicate what supply side reforms could achieve. Your question is one that I really, I'm afraid, find very difficult to answer indeed. I don't have a straightforward answer to your question. I wish I did. Manoj, can you help at all, do you think?
It really is a hard one, particularly given the political climate. I think perhaps one of the things that could change over a period of time is some of the political opposition that is currently in place to immigration, particularly if those policies are curated towards the kind of workers that are required from a long-term point of view. There are many stories on the educational side that are difficult in Germany, for example. A lot of the people there I know argue that it's harder to find people to participate in the apprenticeship student programs. And that makes a pass through into industry a little bit harder. I mean, these are the supply side stories, but really what they can hope to achieve is greater integration into the emerging market side. Nathan, one of the points that you had made earlier, and they seem to be far more connected to the emerging market side than the advanced economies. It's actually surprising that across the board, the connectivity of European nations, even at an individual level, is quite uniform. So they're far more open to those kind of connections. And possibly the one thing they can get the benefit of is if indeed you've got an inflationary impulse that is clear in the US economy, which leads the dollar lower, then that gives the ECB perhaps a little bit more room to maneuver. But again, it's much easier to answer that question in the context of emerging markets who have a ton of inefficiencies that they need to deliver. If you're like the euro area, which is already close to the efficiency frontier, it's a harder question. Immigration would have been an obvious answer. Investing more in productivity would have been an obvious answer, but it's hard to see how that can be delivered in practice. It's a tough one, really tough.
Thank you. So we practically exhausted our time. So I'd like to thank you again for staying the additional 15 minutes for a lively discussion. We had a lot of attendees remain in the last optional 15 minutes. So I think that proves that these things are of great importance and interest. I cannot hold myself, but being in Europe, you probably too. But in terms of fighting COVID, there are a lot of efficiency gains that still could be made, but leave that aside. So I'd like to thank you and good evening to you both, and bye-bye to everybody, and see you in our next week seminar. Bye.
Thank you for having us, Nathan. It was a pleasure.
Thank you, Nathan.
Thank you.